Hello and welcome to the Netwealth webinar on Can I Still Afford to Retire as Planned? My name's Tom Kimchi and I'm a client advisor at Netwealth. Today we're going to be looking at people with retirement looming, and we're going to think about some of the important factors to model for and the elements to control in planning and funding your retirement. So particularly relevant now where people are likely to have seen some reductions in the value of their pension funds in recent months. We're going to be looking at how much income your retirement may be able to provide for and how long this may be able to last for. We're going to look at how to better manage your drawdown, and we're going to look at the role of modelling. We're going to see how our online planning tools at Netwealth can help you to make more informed decisions about your retirement and sort of consider various parameters. If you have any questions at all, please get in touch through advice@netwealth.com, either during or after the webinar. And if you have any teething issues with the sort of technology, the webinar setup, please just try refreshing it first, as that normally solves the issue. So we're going to start by looking at some of the variables to consider when we're about to retire. And we start by looking at the left-hand side, which are things that you can't control. And on the right-hand side, we've got things that you can control, which we'll come on to afterwards. So first of all, you can't control inflation, of course. The Bank of England have a target of 2%, and actually over the past 25 years, they've been quite good at meeting that target. And the average level of inflation has actually been about 2.05%. And now with coronavirus and the subsequent effects, there are some inflationary pressures. So governments are printing lots of money, but there are also deflationary effects. So, people spending less money because incomes might be reduced. So overall, it's hard to say what it's going to be, but it's uncertain. We can't control it, although we can certainly factor it into our plans, both by assuming our income needs to grow with inflation and by making sure we're invested in assets that are likely to grow with inflation. We can't control life expectancy, of course, but again, it's something we can certainly factor in. We've got portfolio value in the middle there at the bottom, which we can influence partially because we can choose the level of risk, which we'll come on to. We can make sure we're not paying too much in fees to hopefully help our portfolio value increase. We can make sure that we use tax allowances and exemptions, so we can influence it, but we can't directly control what happens in markets. And then we've got things that are well within our control when we're retiring, which is the target level of income we want. So how much are we going to spend in retirement? And then our retirement age, of course. So we can choose whether we retire now or whether we delay it a year or two, hopefully earning some more money in the meantime or letting our portfolios grow before we begin to draw upon them. So the first thing we're going to look at is investment return versus risk, which is going to influence quite strongly the overall portfolio value in the end. And what we've got here in the grey bubbles are various components of a portfolio. So we've got US government bonds in the bottom left, which have lower volatility as shown on the x-axis, but then also lower average annual returns as shown on the y-axis. At the other end of the chart, we've got US equity, which has had higher volatility in the past, and this is the last 25 years, and we've got higher average returns. Typically, to get a good spread, you want to have a balanced portfolio which combines the asset classes and means that your portfolio is not going to be quite as volatile in any given one year, and you smooth the path of returns in the long run. And ultimately, the asset allocation, the mix of these assets, is going to determine what your average return is going to be and how long the portfolio is going to last. We've got here as an example some of the Netwealth portfolios. Portfolio 1 on the left-hand side here is mostly focused on bonds and cash, so it's a very low risk. And we can see here over the past 25 years what happened in the strongest one-year period as denoted by the blue bar, and what happened in the worst 12-month period as denoted by the grey bar. So we can see for the risk level 1 portfolio in its strongest year over the past 25 years, it returned 12.9%. In its weakest year, it returned minus 0.7%. At the other end of the spectrum, we've got risk level 7, which is far more focused on equities, and it returns 45.8% in its strongest year, and it was down 31.3% in its weakest year. As you might imagine, the average return in any given year increases as you go up the risk spectrum, but it's important just to think about what level of risk you want and where you're most comfortable, because it's no good going for a higher level of return but then being very uncomfortable, having sleepless nights, and particularly during periods like we're experiencing now, there is a lot of uncertainty, there is a lot of volatility, and if you're not comfortable with it, and if you might be tempted to sell at the bottom, then it's certainly not right for you. Moving on to the next slide, we're going to put some of recent moves in context actually to help hopefully give you an idea of what might be appropriate and where we currently are. So it's the same charts as before, but this time with the blue and yellow dots, we're putting what's happened in recent times over the top so that we can compare that to the sort of extremes of the last 25 years. If we look at risk level 4, right in the middle, which is roughly 50% in equities and 50% in bonds, we can see that even though in its weakest 12-month period, which was during the global financial crisis in 2008, it was down 19.9%. Recent market moves, and this is to the end of March, haven't actually been anywhere near as severe as this kind of portfolio would have seen in 2008. So we can see now by the yellow dot, during Q1 of 2020, so from in January, February, and March, a risk level 4 portfolio, a balanced portfolio, 50% in equities and 50% in bonds, was down 10%, whereas during the financial crisis in 2008, it would have been down 20%. So this is really to show you that although market moves recently have been worrying, they have been distressing, in the grand scheme of things, they are within what you should expect for this type of portfolio. So if you're going to invest in a balanced portfolio because you want to achieve returns ahead of inflation in the long run, and you do have a long enough time horizon, as you probably do if you're coming into retirement, then you need to sort of accept that and be comfortable that that can happen. You know, it's never a nice thing to see when markets are down 10% or 20%, but if that is within the range of expected parameters and there is the upside to see in future years, then it probably makes sense to stay with it. If we look at the blue dot as well, we can see 1 year performance over the last 12 months. And this has actually improved in recent months, so since March, but the portfolio is only down around 5% at this point to the end of March. So again, if you look at the whole 1 year period, it wasn't actually that significant a drawdown in the grand scheme of things. So then we think about, should you invest, particularly when times are stressful compared to just keeping the money as cash? And here we again look at the balanced portfolio. If we start by focusing on the dark blue line at the top, we can see that investing £500,000 and withdrawing £36,000 per year. So this sort of simulates a retirement income stream. We can see that, sorry, if we start with the dark blue, and that's cash actually, by drawing that down over time, over 10 years, we're going to be left with £185,000 at the end in nominal terms. We look at the grey line now, and this covers 2007 to 2017, so it incorporates the global financial crisis, seeing big drops in portfolio values. We can see that investing with the same amount at the start, £500,000, and withdrawing £36,000 per year, it does end up quite negative to begin with. Coming into 2008, the portfolio was down significantly and it dropped from £500,000 down below £400,000. But then because it's invested in assets that are going to grow in real terms over the long run, over time, it does start to outperform cash, which is probably the minimum you're expecting if you're investing in a balanced portfolio, but it just shows that even if you do get unfortunate with the timing and there are drops soon after you invest, like there would have been here, so the person started off in 2007, the first 2 years are pretty negative. Within the next 8 years, though, they soon recovered, and they are up to £333,000 in the end compared to £185,000 if they had stayed in cash. So this just shows the benefit of investing in portfolio in real assets, even when you're drawing down and even when markets can be turbulent to begin with. And here we show how markets perform after big falls. We're looking here at the US market index, and that since 1927, there have been 19 falls of 30% in the US stock market. So similar to what we saw at the worst peak to trough period recently. And each row of this table shows a time period later, and was the market higher or lower? And if you invested, what would have been your median return? So if we look at 30 days later, after a drop of 30%, out of the 19 occasions, 13 times the market was higher 30 days later, 6 times the market was lower, and the median return you would have got from investing 30 days later, after 30 days, sorry, it would have been 3.8%. If we now go to the end of this table, we look at what happens 5 years later in the past. So each time the market's dropped 30%, if you would have invested, what would have been your median return after 5 years? And we can see that's 60%. So sometimes it would have been higher, sometimes it would have been lower, but the median return is 60% 5 years later. So by sticking it out, by not panicking and selling, you are rewarded typically for being invested. And you might think now's different. It's quite a common concern we've had, people thinking that, okay, we can look at the past, but does that translate to the future? Of course, no one knows for sure. We're not psychic, but here we've got some Imf growth projections. If we start by looking at the left-hand side, we look at the global economy over the last 3 years and the projected GDP change. We can see that for 2019, the global economy was up 2.9% in GDP terms. For 2020, it's projected to be down 3%, so taking away 2019's gain. But then for 2021, it's projected to be up 5.8%. So it is just a projection, but it shows that hopefully things aren't quite as bad as they may seem. Now we're going to look at sort of specific options when it comes to your retirement and how you can help influence the level of income you might receive. So we're going to look at, first of all, with pensions specifically, which are often the biggest component of someone's retirement fund. We're going to look at the difference between an annuity purchase and a flexi access drawdown setup, which is where you just take as much or as little money as you want from your pension. So if buying an annuity now, clearly you're going to be locking in losses you might have experienced so far, but there are some benefits to that potentially. So you would be getting a guaranteed income for life. Regardless of what happens to markets in the future, you are due to be paid out a certain amount of money from your insurance company or whoever you buy the annuity from. There's no ongoing management, which might take out a significant amount of time and stress from your life. And again, you don't have the market risk. There's no risk of inflation eating away at your real income if you get an inflation-linked annuity. And there's no risk that you live to 130 or 120 and run out of money. But you do have to bear in mind, of course, that annuity rates are very low at the time of this webinar, certainly, and they have been in recent years. And if you were to pass away soon after buying the annuity, then pretty much all of that value is lost compared to a flexi access drawdown, whereby the money in your pension when you pass away can go to your beneficiaries or heirs. The other key benefits of flexi access drawdown, as we touched on a little bit earlier, is you have flexibility. So you can start off with a high level of income if you wish. If markets are down at the time of retirement, you can wait for them to recover. And as I just mentioned, estate planning possibilities are enhanced. So there's a lot more you can do with the pension. It's not in your estate for inheritance tax purposes. So if you have other assets, you can just let your pension grow. And that's a nice little nest egg to pass on to your children, and you can use your other assets to fund your retirement. There are some other considerations though. So the lifetime allowance needs to be considered if you have a particularly large pension, which again could entail taking on financial advice for that or extra things to consider nonetheless. And you also have the risk of markets performing badly in any given period, which might just worry you, or it might mean that you can't afford to spend as you wish. And there's also the risk of inflation running away and you living for much longer than you anticipate, and again, the money running out for that reason. We're just going to look now at some of the differences in the starting levels of income you can take when you buy an annuity versus when you enter flexi access drawdown. So just to sort of set the scene, with the annuities here in the light blue for each age group, we're going to assume it's a joint life annuity with 50% of the starting pension paid to your spouse upon death, and it grows by 3% each year. With the dark blue bars, we're looking at drawdown, and it assumes that the money is invested in a balanced portfolio with 60% in equities, 40% in fixed income or bonds. It assumes that the pension commencement lump sum, the tax-free cash is taken out and invested in a general investment account or an ISA. And again, the income at the start that we see here is inflated by 3% until age 95. So starting on the left-hand side, we can see if you retire at age 55 and you have a £1 million pension pot, with an annuity, you might be able to get around £20,000 per year. With Flex Excess Drawdown, you might be able to draw down £30,000 per year. Again, they both inflate by 3% each year, and the drawdown fund runs out at age 95. If you were to delay your retirement until 65, then the annuity you'd be able to purchase would be about £29,000, and the drawdown fund would be able to raise around £39,000. And we can see the relationship generally is the longer you delay your retirement, the more income you can receive. And by going into drawdown rather than purchasing an annuity, you can start off with a much higher level of income generally. And we can see this same relationship here, but this time looking at different pension pots. So we've got a £300,000 pension, a £600,000 pension, and a £1 million pension. And we can see that with the £300,000 pension, for example, we can see depending on when you retire, you can draw more money. So if you're retiring at age 55, you can withdraw just over £10,000. If you retire when you're 70, you can withdraw more like £15,000. By doubling your pension, you're roughly doubling your level of income, as you can see there. Now we're just going to focus on the longevity angle before we go to a demonstration of how our planning tools can help you project for your pension personally. And this is just to mention that although you might not necessarily expect to live a particularly long life, although I'm sure everyone hopes they do, there is often a greater chance than people realize of reaching these later years. So if you're 66 now, your life expectancy might be 87 years old, but you actually have a 1 in 4 chance of making it to 94 and a 5% chance of making it to 100. So it's just important to factor this in and to be aware that it is a real possibility, even if it isn't the most likely outcome. Now we're going to go to our website so we can look at our planning tools and we can see how you can actually plan for your personal retirement and see how long your pension or your ISA or general investments account might last you in retirement. So I'm just logging into a demonstration account and I'm going to add new portfolio so we can have a look at these tools. So the first thing we're going to do is choose the base currency, which is going to be British pounds in this case, and we're going to choose a retirement goal. Although other goals are available, such as just invest if you just want to beat inflation over a given period, or you can save for a significant purchase, for example. But today we're focusing on retirement. First thing we need to do is choose a target monthly income. In this case, we're going to say £2,000 a month. And that, by the way, is the amount we want to draw from the portfolio. So people might have a state pension in addition, or they might have rental income from a buy-to-let property, but this is just the money to be drawn from their invested portfolio. We're going to apply an inflation rate of 2% because that's the Bank of England target and our best guess, but this can be adjusted if you think your personal rate of inflation might be a little bit different. We're going to input our current age, which we're going to assume is 60. And we're going to say that the age we would like the retirement income to start. So when do we plan to retire is now, so also age 60. And our target length of retirement, in this case, we're going to say 30 years. We click next and we now choose the account type. We're going to choose pension in this case, although general investment, ISA, junior ISAs are available. Now we're now going to look at the contribution level, which is how much is going to be used to fund the pension. We're going to assume the pension is worth £600,000, which of course means it'll be a transfer in from another scheme. And now we come to the all-important risk level, which again will be the driver of the long-term returns. We have some information here that helps you sort of consider what might be appropriate, your ability to take risk, your willingness, your need to take risk. We're going to start off with a balanced portfolio, risk level 4, which is roughly 50% in equities, 46% actually, and 50% in fixed income or bonds. You can see again how that performed in the worst 12-month period and the best 12-month period over the last 25 years, and we can see discrete annual year performance there. But if we click next now, we're going to see a projection of how likely this goal is to being met. So what we can see here is the portfolio starts off at £600,000. £2,000 is drawn per month, although that inflates by 2%, and it projects it for 30 years. And we can see that in the average scenario, it does meet the goal with £10,000 remaining. So that says to us that this retirement plan is sound and it is likely to be met, although there isn't that much room for error in the average scenario. What we can do now is we can iterate a little bit. We can think what might happen if this person wanted to spend £2,100, for example. And it's probably quite obvious, but as we were so close to not meeting the goal there, it's probably going to make it so that this money actually runs out now. So by spending £2,100 per month instead of 2,000, we can see that in the average scenario, the money is likely to last until 2048, which is a year and 6 months before the end of the goal. So they won't quite make it to age 90 with this fund remaining in the average scenario. So this then highlights a few options. We can instead think maybe, what about if we delay our retirement until age 65? What does that look like? This gives the portfolio 5 extra years to grow at the start before the money starts to be drawn upon. We can see in this case, it does last again. So the first 5 years here, it's growing a little bit, and then money comes out. And then now the portfolio does meet its goal. Alternatively, you might wish to consider a different level of risk. In this case, they might say, what happens if I choose risk level 3? Maybe they haven't got the appetite, or maybe they just don't think there's any need to take additional risk. You can have a look at that as well. In this case, because there's a lower average return and there is such a long time horizon, the portfolio doesn't have as much of a chance to grow and runs out 3 years and a month early. Alternatively, you can again choose a higher risk level, maybe risk level 5, and see how much money is likely to be left in the pension in this case. And again, in this case, it's £348,000. The money is outside of your estate, so it's a nice way of passing on money to beneficiaries. These tools are free to access if you want to, after this webinar, to have a look for yourself, to type in your pension fund, the amount you want to spend when you're planning to retire, and you can have a look at different risk levels and see how long your pension fund might last. If this client wished to proceed, they would click Review and Invest. They would look at the information they've typed in, make sure it's all correct, review the risk parameters, read some risk warnings, and then it goes to an account basket page where they can give their portfolio a name. If they wanted to add a portfolio such as an ISA, they would do so here and repeat the same process. I'm going to go back to the presentation now, and we can look at how else Netwealth help clients think about retirement planning. Great. So we think whatever your objectives, the really important thing to do is to try and take control as much as you can. So we talked a little bit about the things you can't control, such as inflation, such as your longevity, but we can control timing the market rather than trying to time the market. And that means making sure that cash is deployed effectively. Times like this make everyone very cautious, and they think, is now the right time? And they often delay for a long time and they miss out on market rallies. But although none of us ever know the exact best day to go into the market, you know, a bit of a cliche, people say no one rings a bell at the bottom of the market. We do know that over the long run, markets do produce good returns ahead of inflation. So by getting invested, you're generally going to get a better outcome. We do know that you can diversify to smooth the path of returns. It's often called the only free lunch in investing. We also know that you can control the tax wrappers you use. So in this case, it might be contributing to your pension. It might be being mindful of the lifetime allowance. It might be sort of carefully managing your drawdown from your pension so that you don't stray into high rate tax bands. And lastly, very importantly, is the level of fees you pay. And we're going to come on to this a little bit more in a minute, but the difference you can pay in fees is quite high, and that can lead to very significant differences in your, in how long your pension lasts or how long your investment assets last in your retirement. At Netwealth, our approach is to combine financial planning with the investment management to lead to better net returns. So the financial planning, that is making sure your goals and objectives are sound and sensible. That's making sure you use your tax allowances, making sure you're mindful of the lifetime allowance, making sure you're drawing down in the most tax efficient way. The investment management, that is making sure you're diversified, making sure you're not paying too much for those investments. And then overall, by doing that, keeping costs low, taking advantage of your tax allowances, you should get a better net return, which should help your pension or your investment assets last as long as possible. Coming on to fees, which are again a very important part of this. We've got here the Netwealth fees. We believe in providing full transparency, and we charge an all-in fee. So that's the top line of this table here. On assets between £50,000 and £250,000 of investment, the Netwealth management fee is 0.65%, and that covers the investment management. So choosing the asset allocation, rebalancing it, taking advantage of any opportunities we see, mitigating any risks we see. It includes transaction fees, custody and administration, sometimes referred to as a platform fee. Includes tax reporting, and it also includes VAT. So that's all included within that top line you can see there. It drops to 0.35% on investment assets over £500,000, and that fee applies to all of the assets, not just the increments above a certain threshold. We've also got the underlying fund cost, which you can see there at 0.2%, and the estimated annual cost of trading at 0.1%, which is the bid offer spreads when you buy the underlying securities. bringing an all-in cost of between 0.95% and 0.65%. And when investing, there's always going to be fees. They're unavoidable to a large extent, but it's about controlling them and making sure they're not significantly larger than they need to be. As we can see here, by keeping fees down by 1%, it can make quite a big difference to how long your assets will last. So again, here we're starting with £1 million. It's in drawdown. It's invested in a balanced portfolio. They're drawing about £3,000 per month in this case. And by paying 1% less in fees, the money actually lasts for an extra 8 years, which is pretty significant when you look at a time horizon of only being say 40 years in this case, roughly, depending on what the actual fees are. But by paying that 1%, and if you think about it this way, investment returns might be 4 or 5%. So if the investment returns are 4%, say, a 1% higher fee than it needs to be is eating into the returns, or it's eating 25% or a quarter of the return you're getting in every single year. So that's why it compounds out to such a big difference. So again, just something really to be mindful of when thinking about your retirement and how long your fund will last and if you can afford to or not. So that brings me to the end of the webinar. We think it's really important in summary to assess the variables. So investment returns, that's going to be very much dictated by the level of risk you choose. You need to make sure it's appropriate. You've probably got a long time horizon if you're retiring, but you also don't want to take more risk than you need to. You need to be mindful of inflation. You need to choose the appropriate level of target income. And the retirement age and how long you live for is also going to be very important and can be modeled for. It's good to understand the potential options you have. So you could buy an annuity, you could go into drawdown. What are the pros and cons? But whatever your goals are, it's important to control the things that you can control and make sure you're modeling for the things that you can't control, but you're quite aware of what they're likely to be. Thanks for listening today. If you have any questions at all, as I mentioned, please get in touch via advice@netwealth.com. And that's it. Thanks very much.